Hello, everyone. Welcome to our AMA session today. Thank you for joining us. Today we'll be talking about going from seed funding to your Series A round. Before we get started, I just want to go ahead and invite you to submit your questions into the questions and topics area below the video. If you have any issues during the session, please use the chat on the side, and I'll be moderating that. I will now go ahead and pass it over to Ari Newman, a partner here at Techstars, who will be leading the conversations with our guests.
All right, thank you. Looks like the echo's gone, which is great. Hi, everybody. Thanks for joining us today. And my name's Ari. I'm one of the investing partners at Techstars. I'm also a Techstars alum. The very first Techstars program in 2007 was here in Boulder, Colorado. I had a company called Filterbox that was in that first program. And as a mentor, investor, and otherwise, I've been involved in Techstars ever since. And we currently invest in the Techstars ecosystem out of a $150 million seed and Series A fund. So I spent almost 15 years as an operator and an entrepreneur. And I'm now finding myself on the other side of the table as an investor, which has been a lot of fun. And I really do my best to remember what it was like to be the one pitching and raising money for various companies over the years, and work closely with entrepreneurs. So I'm really excited about the AMA today. This has been sort of an ongoing, evolving thread that started at CES with a panel that I did about getting from seed to Series A. There's a blog post on my blog about it. And, getting from seed to A is a pretty hot topic. We've gotten lots of questions around it. And I'm really excited to have Todd and Michelle join me today so we can discuss it further. A lot of you guys have already asked a bunch of great questions, and we'll get to those questions after we do about 15 minutes of dialogue on our end about some of the key elements of getting from seed to A. So without further ado, Michelle and Todd, would you guys like to intro yourselves?
Yes. Do you want to go first, Todd?
You got it.
Okay. My name is Michelle Crosby, and I am the founder and CEO of Wevorce, and we are a company that is dedicated to changing divorce for good. And when you are setting out to fix divorce, many people ask why. And it is I would classify myself as an impact CEO. I've been a very experiential learner, and from the time I was 9, was on the courtroom stand in my parents' divorce custody battle when one of my parents' lawyers walked up to me and asked, if you were stranded on a desert island, which parent would you choose to live with? And it's that moment that really led this. It was the catalyst for going to law school, wanting to fix family law, building a career in family law, realizing then at that level it was broken from the professional side, and realizing after years of developing a practice that I needed to get out there and create the solution. So that's where we created Wevorce, and it's a step-by-step approach that's really focused on helping families get through of letting go of the role of husband and wife while focusing on being mom and dad, because that is the part of the relationship they will always keep. So I am a first-time startup founder. I jumped to startup culture knowing that they were the best at creating change in marketplace behavior. I had the opportunity to go to Techstars and Y Combinator. So I was really blessed by both those opportunities. We actually chose Y Combinator just because of location in the Bay Area for that class. And then have kept a relationship, though, with Mark Solon the whole time. So I've known him since the very beginning. So he's really been my connection to Techstars, and they are now leading our Series A.
Awesome. Todd?
Cool. My name is Todd. I am the CEO and co-founder of AdHawk. AdHawk is the easiest way to manage your digital advertising. What we do is we aggregate your digital advertising data, so data from Instagram ads or Facebook ads and Google ads, and put it into one dashboard that updates in real time. We then use data science and machine learning to give you optimization tips that you can accept or reject. And if you accept one of those tips, it programmatically changes your account. We like to think of ourselves as a digital advertising account manager that sits in your pocket at all times. My background is that I worked on the AdWords team at Google. I was there for about 2 years, which is where I worked on a team called the Accelerated Growth Team, where we focused on working with high-profile startups and helping them grow through Google AdWords and Google Analytics. From there, I joined Techstars as well, and we recently closed our seed round. I'm a first-time founder, first-time CEO, and excited to share with you guys everything that I learned in the process.
Awesome, great. Are you guys also hearing the echo that I'm hearing when other people are talking? Or is it just me?
It's okay on my side.
Okay, maybe when we're not talking, go into your little video window and just hit mic mute. It might help. So, awesome. Okay, thanks everyone. So let's jump in. So the first thing I want to chat with you guys about, and again for some framing for the audience. So Todd at AdHawk has just gotten through a seed financing. Michelle's just getting through a Series A, and one of the things that comes up is, what does it take to get a round closed on either end? And there's been plenty written about metrics, where you need to be as a business to get a Series A done. But on the seed side, it's a little fuzzier. And oftentimes seed rounds are really about the team, the market opportunity, the company's ability to execute, really subjective things, maybe with the exception of a top-down market sizing exercise. So one of the things I would love to talk about is, based on your own experiences of raising money, was there one or two things that you felt really got investors excited about your story or about the market opportunity? Was there a tipping point in these conversations that you had where it went from, here's my pitch, here's what I'm doing, to people going, okay, I totally get it, I'm excited, I want in? And what advice would you have for other entrepreneurs that are trying to create that kind of interest and momentum when it's not based on data and traction and margin? It's based on the kinetic energy or the future potential of the business.
So I can start with this one just because we obviously just went through this. A couple of things that I remember about the process. The first thing, I remember a lot of investors asking me, why you? Why is your team uniquely positioned to pull this off? After talking to a lot of investors, what I began to realize is that, they've heard every single idea in the book. Maybe a variation of that idea in different ways, but they really want to know, why are you uniquely positioned to pull off this vision? So a big thing for us was focusing on the team, focusing that, hey, we worked on the AdWords team at Google, which is why we can pull something off in the digital advertising space. That was a big push for us and something that got kind of investors talking and interested in what we were doing. The second thing I would recommend is always know your elevator pitch, always know and be ready to pitch at any moment. A quick funny story about that is we were walking down the street with our Techstars jackets on, and we had just graduated from Techstars. We were in New York City, and a guy walks up to us and says, "Hey, you're in Techstars. What do you guys do?" And turns out he's an investor with Techstars and ended up being one of our investors. So, always knowing your pitch, always being ready to pitch, and not knowing who you're going to bump into is something I always recommend. And then the third thing, we were a little unique. We came into Techstars really pre-product. We had not much traction at all. We had some signups. We really had an idea. So we had to sell a vision. But along with that vision, we wanted to show some sort of metrics and some growth. So instead of showing, user engagement metrics or MRR, we had to focus on, okay, how many landing page signups can we get? And how can we get a beta out there and get feedback as quickly as possible? And that's kind of what we did since we were so early on.
So I would just like to comment on that, because Todd, you guys did a great job creating what felt like momentum and early market validation, even though you didn't have a product that was in market that could generate revenue in those early days. And a lot of investors will tell you, well, you need traction to get a round closed, but traction is a proxy for progress. It's a proxy for engagement. And so if you're not ready to drive revenue, if you're not ready to sign up users, but you can build a wait list, you can build interest, you can drive engagement to landing pages and show that the market is interested in your solution, that is a great way to create that forward momentum and that interest, with even though you're not at the place where you could do the other things. So if someone says you need traction to raise a round, just remember that there's multiple ways to get there, and that it doesn't mean that it's just revenue or just people signed up.
Yeah, totally. And one thing just to piggyback off of that, and then I'll pass it on. We were also in a unique situation that I hear a lot of people commenting on, is that we were two business co-founders. So we actually didn't have any technical background. So for us, it was, how do we show this vision and this traction without writing basically any lines of code? And at AdHawk, we believe that, there's a ton of tools out there, whether it's Google Sheets or InVision or all these different types of tools, that you can get a beta out there and start getting traction on that. You can look outside of, hey, I need to build this exactly the way I envisioned it. You just want to get the idea and the concept out there. So for us, it was, we have a digital advertising dashboard, but we were able to have our first MVP, which was just a Google Docs spreadsheet that we downloaded data, simplified it into a spreadsheet, and sent it out to all of our users every day. Now, it wasn't perfect, but it simulated the same concept of what our grander vision was of, an aggregated dashboard that actually updated in real time.
Cool. And so, Michelle, I'm curious what your thoughts are, right, on this, on the series. You've obviously you raised money before, and then with Series A, you were way past the fake it till you make it stage.
Yes.
Right. So as you were putting together your Series A round and talking to investors, how did that differ from where you were when you were at seed stage?
There were some threads of, when I approached at the seed level, coming off of demo day, and I think it's probably a little bit of my lawyer background showing up. I had a theory that money was the easiest problem to fix, and it was actually developing an investor, like who was the best fit for us, helped us create a really great synergy of investors right from the beginning. Because I think if capital can be very expensive, and if you just focus on the dollars, you miss out on what really actually helps the company survive, the network, the relationships. And so very early on, even at the seed phase, I developed a strategy. It was a 3-pronged strategy. And for every investor meeting that we took, there was always a meet and greet section. I called it the bromance. And however much time they would give me, I would do a little bit of research about who is this person. I called it the Cracker Jack surprise. Like, I know that Ari loves bicycles. So it was something on that human connection of who is this person, what brings them to life, and how are we going to relate to each other? And so the bromance section was always how I began my investor meetings, to get to know them. And then I would go a little bit more into the pitch and what we were doing and how we were fixing a problem in the world. And then I would always leave with a close. I think when you're in fundraising mode or looking for capital, it's a very tough mental time. It's a very exhausting time. You really just want to focus on your company, but we went in it hard and fast and wanted to get over with. So we kind of got in there, closed the round within 10 days. But in order to keep it moving and get that sense of momentum, we packed in meetings, and I had next steps after every meeting. After we got through bromance section, pitch section, and then the close, I always had a question in my pocket. What do you like about Wevorce? Because you will get a lot of false positives, and I think that's the death to momentum. People don't want to tell you, you're so passionate about what you're doing. It's hard to say no. But I was always fishing for that, like, please tell me no or yes, or even if you get the soft kind of kick, I would say, great, what do you like about Wevorce? If there was a positive statements, this is what they liked, and they were interested, I'd say, great, we're keeping track on reserves so I don't get oversubscribed. How much are you interested in? And how long do you want me to hold that? And they'd say Monday. And I was always looking for a framework to keep that momentum going so that I wasn't left holding the uncertainty of what was next. Right. And that really helped at the seed round. And then when we started, the difference I would say for Series A is that that one was really relationship focused. At that level, I wanted to find the right fit that believed in what we were doing. And the capital wasn't necessarily the pressure, the pain point. It was really just about who could really help us with a network to grow, to help us brainstorm where we went next and help us move forward to that next level from kind of startup idea into emerging company.
That's great. So I want to double click on two things you said quickly, which is really interesting, and I want to make sure everyone caught it. you did a great job with your seed round around creating scarcity.
Yeah.
Right. So if with seed investing, because it's really like, is there a big market potential? Is this team awesome? Are they getting things done? If there seems to be scarcity, not a lot of room in the round, and you're giving them 3 days to make a decision, and you're telling them you're already oversubscribed, you're creating that forward momentum and forcing the investor to make a decision quickly. So it's a great tactic, even if the truth is you're bluffing a little bit, right? If you were the one creating momentum, which is really smart. And then the other thing I thought was super interesting, what you said was, your Series A was based on a relationship, but your seed was based on like fundraising strategy and creating momentum, right? Usually that's the other way around. So I thought that was super interesting. One of the things that has come up in this topic a bunch about fundraising is, as an entrepreneur, hearing no is really hard. And every time you hear a no, you think that the investor is voting on whether you as a person and a human and your business are or are not going to be successful. And what I've learned over the years is, although it's sometimes hard to accept, it really truly is more like dating. And there has to be a match. And so I think you also, Michelle, did a great job of creating the bromance, which is, are we connecting on a personal level? Do I want to spend time with this person? Is there a relationship for us to be had outside of just looking at your balance sheet? And I think that's super important, right? Investors get pitched every single day. If you're only going to do 10 deals a year, it has to be something that you really, truly want to spend time on. So the entrepreneur's job is to figure out quickly, are we going to go on a second date? Is there a relationship to be had here? Do we actually like each other and want to hang out? And so much of the fundraising can be, you can either figure out that you should not waste your time or that you should invest time based on whether you have that connection.
Well, and like attracts like. We had this great experience at the seed round of, because I actually said no to a few people, because it just clearly wasn't a fit. And I knew that moving down, again, because I've been a lawyer on a few deals that go sideways, I was a little bit paranoid, because if you don't get that kind of connection right, you can waste a lot of time maintaining a relationship that wasn't on track from the beginning. And so in that, when I would find the one that was a really good fit and we would spend the time, get to know each other, do the pitch, they liked it, they would bring in 2 more people just like them. And so I really believe in that like attracts like, and that's a lot of that momentum, is if you get a really good group of investors behind you, they are in there, they believe, like when your hockey stick growth up into the right stalls and you need problem solvers. I mean, we would email our investors and say, hey, we're kind of stalled on traction and out of ideas. Can you guys send us every lawyer you know for contact? And they would get in there, they'd help. And I really accredit that a lot to just really building that. We had an acquisition offer, and I formed an advisory committee around that, because there's so many unknowns. Who knows what you're going to face once you take the money? And having those kind of relationships that I knew the people, I had spent some time getting to know them, really helped take that pressure off of like feeling like you have to know everything that's coming, and allowed us to kind of get through it. I think it's always stressful, but it really helped to have a good tribe around us. Uh-oh, you're on mute.
Okay, well that would help, right? Sorry. We're going to jump into some of the questions first, but I'd love to hear from both of you on, now that you've been through these financings. One of the questions I get asked all the time is, hey, I'm out raising money. Our metrics are good. There's, it's an interesting business. There's a big opportunity, but I can't get anyone to lead. I got a bunch of people that say they're interested, but nobody wants to lead. And now that you guys have both been through it, what are your thoughts on that? And did you have that situation? What did you do to get somebody over the line?
Yeah, I could talk about that. We definitely had that situation for us as well. We had a lot of investors that were interested and said, we want to commit X amount, but we need to have a lead. We need someone to do the due diligence and actually write up the paperwork. So the way that we we went after that was we said, okay, we took the commitments and we kind of used those commitments as an advantage, like what you were saying, to the scarcity. So if we were raising $1 million and we had 200 committed, we would then say, hey, go to the next investor and say, hey, we have 800 left in the round. Would you be interested in being part of it? And then every time we got a little bit more of a commitment, it would be more and more scarce. And then when we had about half of the round committed, that's when we really started going after leads and saying, listen, we already have half the round committed. We just need a lead to come in. There's only, half of the round left. It can all be filled as soon as you're ready to go. But I think when the scarcity part of it was what helped us. So getting those commitments first, getting those verbalized and making sure they're definitely in if you do get a lead, and then using that to your advantage to then approach all of the different types of leads and know who is a lead investor and who isn't a lead investor. Do your research beforehand, and use your commitments to your advantage is really what I would have to say.
So a couple of folks are asking, do you really need a lead? And listen, there's lots of seed rounds that get done as party rounds, and you don't have a lead. The value of having a lead investor is that you've got one person who the rest of the investor syndicate sees as an anchor. Two, they're typically the ones that help you set terms and sort of trust that someone in the industry is setting pricing. And I think where a lead really comes into help is that even if they're not formally on your board, they're sort of stepping forward and say, I'm really passionate about this business. I'm going to help. And inevitably, almost every seed round has some sort of follow-on financing. The days of you doing friends and family and then seed and then A and B and C and having this perfect story about fundraising, it's BS. It doesn't happen that way. There's seed prime, there's the second seed, there's the bridge to the A, there's the bridge to the B. I mean, fundraising is messy, and as an entrepreneur, you're constantly fundraising. So it's not that simple. And if you have 5 or 6 investors, or somebody asked, what about 10 or 20, 100K investors? Here's the problem with that. Sure, you can get $1 million put together, but when you need more money, all of the investors just look at each other for signal, right? And so if you've got 20 people staring at each other to figure out who's going to put some money in, and you need to raise another $2 million on top of the $2 million you already raised, somebody needs a very strong signal of confidence to then go, okay, well, if you're going to put more in, I'll put more in. And if you've got a lead that put a little bit more money in or is deeply involved in the company, that's what sets that signal. And so don't try to avoid a situation where you've got a bunch of people that you convince to write you one check, but aren't going to be there for 2 or 3 more checks after that. What you end up in is a very tough situation where when the business is actually doing well and you're making progress and you need more money, you have to spend all of your time herding cats trying to squeeze a couple bucks out of them. So a lead can be helpful in that way. On the inverse, if you have a lead investor, but every other check is very small and they don't want to put more money in, then you have to manage negative signal as well. So that's the flip side of that coin. So, all right, we are now at 24 past the hour. So I want to go ahead and jump in and answer the community's questions. We got lots of great questions here. So the one that got some of the most votes are, how do you know how much money to ask for? And I don't have an answer for that. And curious what Todd and Michelle think, but as an investor, you ask for how much money you need to get to the next major set of milestones or proof points with a little padding. So in an ideal world, you're asking for 16 or 18 months, and your operating plan to get to a material proof point is more like 12 months. So if you are asking for 11 or 12 months of of money, what really happens is when you're starting to get low on cash, which is like month 6 or 7, you have to go out and raise some more, and you don't have enough data. So then that next raise becomes difficult. So make sure your runway is longer than the time that you think you need to get to that next set of data, so that you're not keeping yourself up at night realizing you're going to flame out before you can even prove you've got early product market fit or can ship your product. So any other thoughts from you guys on that?
Well, I think that some of the best advice I've gotten along the way was from Brian Chesky at Airbnb, who said, startups don't die, founders quit. And so I developed the mantra of don't quit and don't run out of money. And that is as hard, and I mean, it's way harder than you think, right? So you raise your first round, you think, I mean, it just always takes longer, and it always costs more than you have anticipated. And I think that's really hard to grasp, and the cadence and, kind of your head down and how you pull your head up and realize, you have to set those goals early on of like, here's what we're going to do with the money. It was really helpful for us. And you got to get your theories going. Here's our theory, here's how long we're going to test, here's the results we expect to see, so that you have a baseline to constantly testing and assessing. Because the money goes really quickly. I mean, my father just said, congratulations on closing the round. Michelle, did you ever think you'd say, oh, we have, $4 million in the bank with the new round? And I said, yeah, we closed 3 and I burned that first round already. So it goes really quickly. And then you're ready for more. And so I think I underestimated that as I set out for seed of it's expensive. You have lots of learning to do. The market's always shifting, and what's the framework that you're going to use to assess how you're doing? And as you indicated, the one thing we also learned is that it's not always clear cut. Because we stalled a few times, right? Everyone gives you lots of advice. When you get the advice of don't entertain acquisition offers unless you really are interested, it's really hard to do. And I think the bigger companies wait on the sidelines and kind of swoop in about the time you're really tired. And so we spent about 6 months kind of deciding if we were going to fundraise or take the acquisition. And it was a really volatile time for the company and something I didn't see coming. And of course, now looking back, all the advice we got was we shouldn't have opened the door. But we did. We learned a lot. I think it made us stronger as a company, but it was kind of death zone for cash flow time. And so we had to start, when we decided to turn it down, really start digging. And we were a little bit stalled because it sucked a lot of energy out of the company. And we had to start finding, what was the story? Like, how are we going to show that we could get out of the hole, right? Because some VCs just go through that box of like things you shouldn't do. And pulling out of acquisitions and doing those sort of things were kind of bad things we had to pull out of. So I think it took us about a year of piecing together, seed plus, one relationship at a time to keep us afloat. So it was a pretty messy year before we started to get recovered and really focused again.
Right. So the question around how much you need to raise,
as much as you can, right? I think a lot of it's a gut level at that stage, early stage, as much as you can, and without the dilution, right? I think you as a founder, you kind of always are watching that metrics. I think having at seed stage, I think it's important to still have a significant amount of skin in the game. So you don't want to, take on money at a low valuation where you don't have enough ownership or, pride in what you're doing.
Sorry, let me interrupt. The one piece of advice I would give people, now that I've seen this a lot, is don't over-optimize around how much of the company you're selling in the really early days. If there's a little more money on the table and it's going to be incremental dilution, I would say take it. If you can find 18 to 24 months of operating runway and you've got to sell 25% of the company instead of 19 or 21, that's going to be way less dilutive over the long haul than having to do a second seed round on previous round terms because you couldn't get there in time.
Yep. And I think we faced that with Series A. I actually didn't want to, my initial reaction was I didn't want to raise as much as we did. I didn't think we needed it, but I think kind of the wisdom of going back to the tribe and hearing everyone's advice. And I think it's multiple factors. You have to look at what the market's doing. You have to look at, really, really what you're doing. But I think it becomes, it's a great thing to do with a group of advisors. How much money should we take? And it took kind of weeks of discussions around it, really digging into what we would do with the capital, how would we use it, how much did we actually need, dilution, market, lots of different variables. And I think getting it outside of your head as a founder into your tribe of advisors is really helpful.
Yep, that's great. Thank you. Okay, the next question that's now got 8 votes. What's the acceptable amount of equity an entrepreneur should offer to an investor, private equity or angel? 5 to 15%. And could a sunset clause be negotiated, X% equity for 5 years, then cash out? Okay, interesting question. So my take here is, I guess my first comment is the market is the market. So, in general, if you understand institutional venture capital, in order for VCs to return funds and provide that 3x IRR that their LPs are looking for, we need to own a certain amount of the business. And so a good mental model is to expect to sell, up to 20% or even a little more of the company at each financing. An investor that only buys 5% of the business in a round, if you're an individual angel or you're a small chunk of a seed round, that's fine. But you would only, as an institutional investor, be comfortable buying 5% and writing a big check if you were incredibly confident this was a runaway billion-dollar opportunity and it was going to work out. But in general, the investors are the ones that issue the term sheets. If a syndicate comes together, they sort of decide what the deal terms are. And I would expect the deal to be anywhere in the range of like 12 to 25% dilution against the existing cap table. The second part of the question, could a sunset clause be negotiated? I would be extremely careful with that. So what that signals to me as an investor is you're already trying to figure out how to get money out of the business before you've created the value. And if that's not the intent of the question and I'm misunderstanding, then I apologize. But, founder liquidity comes down the road. It comes when there's a Series C or a Series D, and it's a big round, and a chunk of that can be bought. Founder common shares can be bought by late stage investors to give the founders a little bit of liquidity. But if you attempt to negotiate a clause in an early financing where you want to get the equity back or get cashed out yourself, it's not market, and it sends a little bit of a weird signal. Okay. The next one really is about convertible notes. Pre-product and revenue valuations are speculative at best. Convertible notes are said to alleviate that by deterring the valuation problem. So so that's true. But I personally have this big thesis that convertible notes have been overused in the last few years. And that's just, that's not Techstars' official stance. That's my stance as an investor. Convertible notes are great instruments if you want to raise money either on a rolling or progressive basis, or you're on the verge of a bigger round when there's going to be a pricing event and you don't want to get into it. But most savvy investors insist on a conversion cap. And so oftentimes that conversion cap ends up being a proxy for setting valuation anyway. And sometimes what you're saying is, well, we don't think our next round is going to happen below this number or too far above this number. So although it is a bit easier, the conversion cap ends up being somewhat of a proxy. So, I'm curious what your experiences have been and if you agree or disagree with my opinion there.
I found that the convertible note was an excellent vehicle for us to get started. It's we use a form of template that all angel investors in Silicon Valley were comfortable with. It allowed a quick momentum of fundraising to occur. It also gave us a fair amount of autonomy to get in there and start figuring it out. So I think at early stage it worked really well for us. We did have a cap that we've set. Again, we used that by advisors who saw lots of deal flow to help guide us. The one tricky thing with the cap is that markets are always shifting, and people do gravitate towards that as the valuation. And I think even mentally I did too. But it is an arbitrary number, and you have to watch it and watch the markets because it's always moving. So I think there is a risky side with that cap if you get too attached to it and your investors get too attached to it. But if you have that right recipe of relationships and understanding, you can have all of the conversations around it.
Yeah, we raised money on a convertible note as well at the beginning when we were pre-product, kind of like the situation you brought up. It was a good vehicle for us to get started. But when we talked to other companies and other founders about this same issue, one thing that they got hung up on a lot was, oh, well, you're giving a 10% discount on the next round and all of this type of stuff. And for us, we kind of looked at it as, a 10 or a 15% discount it's totally fine for us to give up on the next round because they're taking a bigger risk. And if you really look at the grand scheme of things, if you're trying to build a really big business, the amount of money they put in for that convertible note, the discount is menial, right? It's not a massive increase in terms of how much equity they're going to have. And for them to take an early risk, we felt like it was worth it.
Yeah. And I think that, one of the things I often advise is to bookmark notes with price rounds. So if your very first financing event is on the seed side is notes, make sure that even if it's not your A, if you're going to raise more money, you do it priced and you convert the notes. Then if you've got a price round and you want to raise a bridge to the next round, okay, you can do that as notes. But just remember, one, there's always a discount, and two, so a dollar is not a dollar. You raise $1, you raise $1 million in notes. That's really 1.2 million with the discount going into the next round. Then what happens? Again, since the investors want to own a certain piece of the business, you have to contemplate whether those notes are going to convert before, during, or after that financing. And if it's before, it's dilutive to you. If it's during, it's dilutive to everyone, and if it's after, it's dilutive to the existing cap table and the new investors. And so there's sensitivity around that also. So you end up selling. Let's say you have $1 million in notes, and then you go and raise a $2 million round. From a dilution standpoint, it's as if you just raised $3.2 million, but you only have $2 in the bank. So you just want to be careful that you don't end up, and that's notwithstanding any sort of additional discount based on a cap. So it can get tricky. And what we do see happen all the time is a company that's raised a bunch of different note rounds and then does a priced financing. There's lots of wrangling and renegotiation and higher legal fees associated with sorting out what to do with the notes when the price round comes. So if you bookend it with priced rounds and notes in between, it works out pretty well. Awesome. Okay, next question. You're bootstrapped. You finished your first year of operation. Now you're going to go raise some money. So first of all, congratulations, Tyson, on running Bootstrap for a year. That's really hard to do. And the market should be appreciative of that. And, at seed stage, for seed or angel, it's all about relationships and the market opportunity. And if you haven't grown an exponential rate because you either need some money to hit that exponential growth rate, or it's just not going to be a high growth business, find people that believe in you and your team and your mission and your market. And the fact that you were able to run bootstrapped and very resource constrained shows that you're going to be conservative with the capital, that you're going to treat every dollar well, but have a very strong story about what you're going to do with the money and why it's now time to raise. If the feedback is, well, if you were bootstrapped this far, just keep going. If you now need money to fund the business, as long as there's enough there where $1 in equals $3 out, and you have some data around that, I think you'll be pleased with the feedback that you get. But again, as we said before, it's still a relationship business, and it's about the opportunity that the company represents in the future, not necessarily based on the data.
And one thing that has worked well for me around those questions of when is it time to raise money and how do you go about it is I always approach, there's this old saying about ask for advice, you get money, ask for money, you get advice. Mm-hmm. And so I think when you're approaching decisions like this, I approached it not in the focus of money. I explored. I did my homework. It's how I met Mark Solon 4 years ago. I called them coffee dates. I was telling anyone that would listen about how we were helping families. And I was facing this question of how do I help more families? And I met Mark, a friend introduced me to Mark, and he said, Michelle, I think this could change the world. How do I help? And I was like, well, I don't know. And I literally had to then go meet with someone who had taken venture capital and go, well, what does it look like? And what am I signing up for? And then, they circled back with Mark and said, Michelle's, she's doing her homework. And so I think some of that philosophy of just really understanding and that feedback from one coffee date after another really helped orient me in where I fit and how to price. And because I think there are so many variables that kind of going through that, get advice, see what people think. Because I from that first coffee date with Mark, I took a year before I took any investment money, even though I think I could have raised some then. But I really wanted, I mean, this is hard stuff. Fundraising is, if you think fundraising is hard, like go execute with it. It's, you really, really have to be committed at every kind of level. And so I took a year and really assessed, like, did I really, really want to go all in on this? And the answer came back yes for me. But I think it's important to ask those kind of questions before the coffee dates and market and advice you get will kind of help you orient where you are. And what the likelihood of getting around put together is.
Yeah. So yeah, go ahead, Todd.
Yeah, and I was going to say, the coffee date thing is something very similar to what we did as well. And I think if you're going to be bootstrapping a business, just because you're not raising capital for the first year, still check in with investors, give them updates, or if that's a coffee date or asking for advice or any way that you can update them on what you're doing, even if you're not raising capital right then. Because in the year, when you say, okay, I'm ready to raise capital, you then don't have to go checking in with all these investors. Hey, look at all this growth that we had. If they've known you for the past 6 months, have seen where you started, where you keep growing month over month, you then, when it's time to raise money, a lot of the legwork has already been done for you.
Yep. I think that line about ask for advice and you'll get money, ask for money and you'll get advice is something to remember. It's come up a lot and it's very true. So a lot of times entrepreneurs get rounds done because they went and asked for feedback or they asked for advice and they never actually pitched. So great thought there. Next one, what's the max percentage of the cap table that can be tied up by ex-employees before A-round investors make an issue of it? That's an interesting one. I don't know that there's a finite number in terms of the percentage, but if you have employees that are like co-founders or early employees that make up the bulk of the cap table, and the remaining founders or key early employees don't have enough ownership in the business for it to feel economically and intellectually interesting to them, that's when investors start to care. And typically, a good investor will help solve that problem as you lead into a Series A or a next financing. If the option pool needs to be refreshed or there needs to be a renegotiation with the founder that is gone because they're holding too much of the company and that equity needs to go to the existing or future investors, the right time to deal with those things is as you get into finalizing a financing. Very hard to fix once you've closed a round and you're just operating. So, Michelle, any comments on that?
Yeah, I mean, since we're a conflict resolution company, I really put emphasis on walking the talk and having those difficult, we call them courageous conversations here from the beginning. What does it look like to break up? We don't want ugly biz horses hanging out there. So we actually it's called the blueprint of we, and we use it to facilitate conversations, especially on key employee hires. Vesting agreements, make sure you have them, and that you're talking about not only best case scenario with your employees, but worst case scenario with it. If in the event you do have to part ways, what does the cleanup look like? Even if you have vesting agreements out there, you can negotiate the cleanup as you go. And I highly recommend it because the team that builds you isn't always the team that grows you, isn't the team that maintains you. There's lots of change, and I really think it's important to have those conversations early on when you're excited and euphoric, because the farther you get into the build, the more tensions that come up, and having a framework of how you do that and how you have those conversations has been really, really helpful for us.
Yep. Great. So yeah, I don't think there's any one answer. And I think that there's probably some nuance in that question that we're not understanding. But if you've got a bunch of people that aren't involved in the business, if they left, their vesting should have stopped. And if they own a bunch of common because they were co-founders and they're not there and it's not interesting for the people that are left, then there should be some sort of renegotiation. And the framing generally is around that discussion. The best capital structure for the company is the one that allows it to be successful and create the most value and return over the long haul. So everybody here wants to own a small chunk of something mega big, not a big chunk of something that's worthless. And that is a fundamental truth about upside. So
And I think what you have to watch out for I think it's even more intangible than just staring at the cap table. It's how everyone feels about it, right? Because if you have people that own a lot and still aren't in there every day fighting for it, it starts to mentally wear on you. And I think that's where I really went in and had to clean some of ours up. Is just because it's so hard, and to get it to one stage to the next stage, if you have too much ownership without people paddling in your direction, it's an undertow. I think it's a mental undertow that you need to either acknowledge that you have or say you're okay, and keep moving. But if you have a mental undertow and it doesn't feel fair to you, then I think it's worth rolling up your sleeve and having some of those courageous conversations with your
Yeah, and you obviously want to make sure as well that the employees in anyone's contracts are all vesting and all of that stuff. And if they put in the time, you just want to make sure people aren't coming in, joining the business, and then leaving. There's a lot of different structures. Maybe Ari can shed some light on that. But for us, we kind of use the classic, 4-year vesting, 1-year cliff to change that situation. If someone were to come into our business, work really hard for 6 months and then take all their equity and leave. So just make sure you have, all of your T's crossed and I's dotted as well.
Yep. Okay. Let's move on to the next question, because this is always the juicy one. $1 million in ARR for B2B or 1 million users for consumer apps is often mentioned as the hurdle for Series A. So I actually talk about this in my blog post on Seed to Series A. This is hotly debated. And as an investor, I think in my experience, if someone says, "Hey, I'd love to have you take a look at my company. We're $1 million in ARR. We're a B2B SaaS business." It's a good data point that says they're doing real revenue. They probably have early product market fit, and they clearly know how to get, close business and get something done. But it doesn't mean that a deal is preordained, or that because you're at $1 million in ARR, you're going to close it. You're going to close around. It is a good early marker. On the consumer side, I kind of think that 10 million is the new 1 million. If you've got 1 million downloads for an app, I don't think that gets it done anymore. On the SaaS side, you could be growing really quickly month over month, and you could be driving that growth through a top of funnel and a customer acquisition process that you understand. And even if you're at 40, 50, 60K in MRR, if you have 6 months of solid double-digit growth and the machine is working and you understand why the machine is working, that might be even more interesting to an investor than actually hitting this sort of artificial ceiling of the 100K. As an investor, I might look at that and go, oh, they're a little early, but maybe I can end up owning more of this business by taking some risk if I like the unit economics and the opportunity. But certainly $1 million in ARR is going to get you some meetings. On the consumer side, I think the hurdle's gone even higher. When we did a panel discussion at CES, and I had a bunch of other investors up there, one of them thought that 250 million, 2.5 million, 250K a month in ARR was the new 100K. And that in this market, when SaaS valuations are under pressure and every company has, greater than 0 metrics, that the bar was moving even higher. So I think ultimately you'll be able to get some meetings, but it really depends on the industry. A quick data point I would give you is, even if you're doing 100 or 150K in MRR, but you're one of 700 different B2B marketing tools that are on the market, and you don't even make it onto the analyst radar, that's a tough business to generate big venture returns, because typically those exits come early. Very difficult to go public or get bought for $1 billion if you're in the B2B tools space around marketing or customer acquisition, because there's just so many products out there. So you could be over that hurdle of 100K in MRR and still have a really hard time. And you might get a lot of really squishy feedback from investors. You might hear, "Hey, this is super interesting. Congrats on the progress. Keep me posted." A lot of VCs do entrepreneurs a disservice by not just leveling with them and saying, "I don't care if you're at a 500K in MRR. I'm never investing in this business because I don't like the space." everyone wants the optionality, and they just don't give you the straight answer. Feel free to dig on that and get straight answers from the investors. So ultimately, growth can be a proxy for the absolute numbers, but north of 100K in MRR with consistent growth, even if you just hit it overnight, you could be at 100K. And if you got there in 2 months because you closed a couple of big deals, it's not going to work. You have to have some history of execution and growth so that the metrics have some confidence behind them.
Yeah, the way we look at it is, when we are going to go out to raise our Series A, we want that money to get fed into an engine. So if that engine is running at 100K MRR or 75K MRR, we just want to make sure that that money, like $1 in, like Ari said, is $3 out. So we want to make sure we have the right story and that we're growing consistently. And we know if we put more money into that engine, it's very obvious what we're going to get out of it.
Awesome. Okay. How does patented technology affect valuation from seed to Series A? Mileage may vary. I think this is a very difficult question to answer. And I'll tell you my own point of view is it depends on the company and the domain. You're not going to get a $15 million pre versus a $10 million pre because you've got some provisional or live patents. What it does is help inform the investment thesis about how defensible the business is. In general, the existence of a patent is not why we invest in companies. It's about the market opportunity and the ability to disrupt the market. If you're until you're a Series B, C, D company and have tens of millions in the bank and can hire an army of lawyers to go defend or protect your patents, these things can oftentimes be a distraction. If I see an entrepreneur that's working in a space that has a real innovation that went the extra mile and filed the patents early because they really believe what they're doing is unique, that's an extra box checked in their corner. But if they don't have that done, it's not a reason to walk away. If they're building something that a lot of big companies have already done and they've gotten patents approved, it might help me feel a little bit more confident. But it is not a valuation or investment thesis on its own. So that's my own take on it.
Yeah, and we were kind of the opposite, right? We don't have, nothing that we have right now is patentable. So we would get the question from investors, well, why can't someone else do it? So you need to be able to answer that question, kind of both ways in terms of execution and actually having something patented.
Yeah. Okay, next question. Why do VCs in many cases avoid hardware startups, and what is the best approach for hardware startup funding? You got to find hardware-friendly, hardware-oriented funds. The challenge with hardware is, we have an internal saying, hardware is hard, and although it's a bit glib, there's a reality to it. Hardware-based startups generally require more capital than software-based because you're inevitably building cloud software and hardware. Series A and Series B are really hard to do because even incremental traction isn't enough to make it clear it's going to be a successful consumer or commercial product. And the operating margins, because of the BOM costs and manufacturing overseas, eat away at the leverage that the business has. So for a hardware company to be massively successful and return a venture fund, it has to be a true home run. Stuff that does okay in the market doesn't return funds. And that's why VCs sometimes have a hard time with it. And also hardware is really hard. And so go find investors that really get it, that know it's going to be a grind, that know you're going to have manufacturing delays, that know that you're going to screw up your firmware and ship 3 months late. These things are going to happen. That's my feedback on that. And then the next one, Michelle, I think this is a great one for you. Living in a state where there's not a lot of VC funding, if any, what's the best way to get introduced to VCs from another state?
So we had one VC. We're in Boise, Idaho. We had one. It was Mark. So that's where the coffee date led. And then, boy, when I finally committed to walking down this path and treating Wevorce like a startup and started exploring, Techstars and Y Combinator were in that zone of being the best of the best to enter into that conversation. And so that's how I did it, was one coffee date, and then follow up with Mark as he was leaving Boise to join Techstars. Opened that door and kind of another window of going, well, what does an accelerator look like? And I think you can do it in smaller locations. I will just share my story. When I first met with Mark, he said, congratulations, I think this could change the world. And one coffee date led to kind of multiple meetings where we were talking about raising money in Boise. And I think he said, oh, I think you could raise about $350,000 here. To me at the time, it seemed like a lot of money. I now know that goes really quickly. And to put it in perspective, right out of YC, we had someone, I sat with coffee for an hour and gave the bromance pitch and close, and they wrote us one check for $350. So that was great. That worked out with Mark. Awesome for you. Yeah. If you didn't have a Mark and you were in Boise and you had to go raise money out of state, what would you have done? Out of state. Find the relationships and see who knows who. Even telephone, video conferencing, we use this all the time because we are in Boise again. So finding those relationships, one will lead to, find the closest one that can get that intro, and do your homework. Like figure out who is the right investor and get efficient at, because it does take a lot of time to develop those relationships, but find the network. Angel list is, you can put those, kind of get the market going in that sense and connect from there. There's lots of, I don't think it's location driven as it used to be, but I would get on the phone and get on airplanes. If you find a good relationship that develops over video, I'd get on a plane. Are you willing to move? Those types of things. If you're really dedicated, I spent 1.5 years in San Francisco to get it off the ground. And so I think there's a lot of variables of, are you in the right space? Market, you got to get to the place where your company can grow.
That's right. Well, and I think doing accelerators is a phenomenal way to solve that problem, right? And putting yourself into existing networks where there's money in other states.
Yep.
Organizations like the Rocky Mountain Venture Capital Association that I'm involved with, and other regional venture groups that get you in front of investors from other states. And if you're able to raise seed capital in your state, turn it around. Make your seed investors go to work for you and help make intros for you.
Well, and you don't even have to start with a VC. Angels are everywhere. Find an angel. An angel can likely lead you to a VC type of relationship. I think if you're looking for investment dollars, angels versus VCs, that's a very different conversation. And if you're at the stage, angels are very helpful and have networks that may lead you to a bigger relationship with an institutional investor.
Yeah. I want to quickly answer Frank's question here. What's the best way to reach out to a specific investor when you're having trouble getting an intro? So if you can't figure out how to get an intro to this investor based on navigating your network, the likelihood that investor, even if you can get to them, is going to do your deal is so small, you should probably spend your time doing something else. Especially for seed rounds, it's a relationship business. If the best sources of capital are the ones that know and trust and believe you and think you're awesome. And just because so-and-so is a prolific hardware investor and you're doing hardware and they were in Fitbit and you're just like Fitbit for this other market, so therefore they're going to also love it. If you're not a known entity to them and they can't vet you and get feedback from you from their network, the likelihood that it's going to happen is pretty small. So I would just be pragmatic about that. All right. Well, let's see.
Finding crackerjack surprises, right? Those emails. If you're buried in emails, like finding a way. I have an angel investor who has been really helpful, and he tells a story about he brought a bunch of us for dinner, and he told a story about a founder that just didn't leave his office, and finally, out of sheer persistence, like he said, "Fine, come on in." But it depends how much you want it. But sometimes just sheer persistence will get you in there. But by the time you get in the door, you better have something really interesting to say.
Yeah, I heard stories of companies sending Facebook ads to serve them to actual investors. But really, what it comes down to is you should be able to hustle and figure out a way to get introductions, and every one introduction you get could lead to 3 or 4 introductions, and that web continues to circle. And doing things like interacting on Product Hunt, interacting on online groups where you can follow up, build relationships, should be really helpful.
Yeah.
I think that's half the battle is learning the skills of how you get in the door.
Todd, question for you. What advice would you give to other entrepreneurs about managing the legal fees associated with the financing?
They're going to be more expensive than you think. That's a really good question. Budget more than you expect, I guess, would be the first thing. There's no reason to over budget. You can always use that money elsewhere. You don't want to be surprised when the money actually comes to you. And you can get a sense during your round, how complicated is your round? How many different investors are part of the round? How far did each investor go from the initial term sheet? These things should start giving you a sense of how much extra work needs to be done. One other thing that I would advise is when you're working with a lawyer, just know in general and check in with them. Hey, like, how long are things taking? Can we get bills maybe every 2 weeks rather than at the end of 3 months? Here's just a massive bill. So there's things that you can do along the way, understanding kind of what they're working on, how long things are taking, and just, continually check in and communicate, because that is something that, we obviously just got over as well.
Yep. Great. All right. Well, I think we're at time.
Yep. Awesome. So thank you everyone for the awesome questions. I see we have plenty left over, and this recording will be available. We'll be holding more sessions like this, either monthly or 2 times a month. So, feel free to follow Techstars on Twitter to find out about the next ones. But quickly before we hop off, I want to just do a quick lightning round with 1 or 2 words from everyone on the call. There's an interesting question that I saw come in, and so if you could quickly answer as we all kind of hop off. How do you handle the emotional roller coaster of fundraising?
Wow.
It's not just fundraising.
Have something else in your life that gives you pleasure, a distraction. If you're a cyclist, something, you need an outlet. You need to have some perspective. If all you do is work on your startup and you can totally go down that spiral, have something that gives you the ability to breathe.
Yep, I would second that and add practice the ability of focusing on things you can control and letting go of the things you can't. And save your energy. It's got to be you got to focus on the things that you can actually impact. You can get very exhausted on emotional, busy energy that doesn't actually move things forward. And it takes practice to do that, a lot of practice. Yeah,
and the last thing I would say is stay organized. The more organized you are, the more you can kind of concentrate and figure out, okay, it's okay if these 3 or 4 investors said no, we still have these in this pile and these in this pile. So stay organized, and I would, +1 everything that was just said here.
And if you really love what you do, you realize that fundraising, as hard as it is, actually can make your company better. Because if there's anything you have missed, someone is going to ask you that question. It's just, you get in the zone and you kind of get focused, and you just realize that every question, every no, you're kind of getting better, stronger, faster.
Awesome. Well, thanks everyone, and feel free to reach out to our guest today on Twitter. And thanks, and see you next time.
Thank you.
Thanks, everybody. See ya.